Oh yeah, let me get rid of this for now. All right, we are going live, and I'm gonna pull up my on my phone to see how we're tracking here. Did you have a nice Christmas?
I did. Yeah, I did. It was good. We had some family in town and just kind of more low key again in that Cleveland. I'm in the Cleveland area, so the county that I live in is one of the surge counties in the U.S. I think we were number 2 in the nation as far as new variant cases. So everything is kind of, let's say, back in lockdown mode, but everybody's a little bit more cautious just because of hospitalizations and just the number of caseloads here. We blew through our old highs for the state of Ohio with ease here the last week or so.
It yeah, it seems like it's everywhere. Ashley actually tested positive last week
Oh no.
or over the weekend. My other partner, he had tested positive. We had an intern who's going to start here on Monday. He tested positive. Um,
They're doing okay though.
yeah, everyone's fine. My dad actually tested positive, kind of messed up our Christmas, and they went and got tested today, and now he's negative.
Yeah,
And
no,
he's
it's just bizarre how certain people are asymptomatic, other people are mild symptoms, and then you have people that just get knocked out. There certainly doesn't seem to be any rhyme or reason how it impacts people.
no doubt. Like, so my dad's going to be 84 years old next month, and he's got a couple of issues going on, but he was asymptomatic and felt great. He's out running around.
Yeah, that's good. Yeah, no, it's still here, and on occasion it impacts the markets, but it just it's just it's hard to believe we're almost back to where we were a year ago as far as dealing with all this again.
No doubt. So, all right, let's get her going. We got people I see here on LinkedIn. So we missed you last week, but I stumbled through on my own. Welcome back, Greg. Very happy to see you.
Glad to be back.
Um,
Nice job, by the way. Next week I watched it; it was good. So
you know what? Let's just start this off. I'm going to show a chart here. Um, Greg and I were talking offline. One of the things as a futures trader, it's very important to know where you've been, which is the reason you look at charts. I particularly like to look at candlestick charts, and I like to look at colored candlestick charts most. So a candlestick shows you the open, or it shows you the high, the low, the open, and the close. And what this means, I got to find a good bar here. So we'll look at this particular bar here. It is red because it opened here and the close was lower than the open. So the opening trade was, right around 1,008. The close was 897. Oh, I'm sorry. This is on a weekly. Pardon me. And the range, the high is the tip of the stick, and the low is the bottom of the stick. But it does a nice job of just showing when you get to turns in the market. I'm going to see, not a weekly. Let's pull it daily. How about we pull it daily nearby? And I'll stretch it out a little. So, yeah. This isn't showing exactly. Well, here you can see right here. This was obviously kind of a bit of a top. And, what you saw was we made a quite a bit higher high. And then it ended up closing down, turned into a red. So you'll see on most turns in the market, the bar that is the turning point tends to be a red bar if it's turning to go lower, or if it's making a high, tends to be a green bar if you're at a bottom.
yeah, and I think Mike, if you look at the low from last week, I think it was the 14th, 15th. You can kind of see how you had the red bars going down. and then you had a reversal green bar, and then exploded off of that low the day after. So I think I agree. I love looking at candlestick charts, and there's a whole science behind candlesticks and different patterns, technical analysis patterns. But at the very least, I think candlesticks, from a visualization standpoint, at least kind of show you, and I think mine are blue versus green, but they at least give you an idea of how many red candles or how many blue or green candles, positive, negative candles, and especially in turning points, inflection points when markets have reversals, I think they're a lot easier to visually see in a candlestick chart.
Yeah, actually, here's a great. This section right here was just before the turn, and the market looked like it wanted to go lower, but it just couldn't make much of a move lower. You see the reds, the size of the difference between the open close is so narrow, and it just couldn't gain any momentum going lower. It was just grinding, and then you explode out of there.
Yeah, and so the other thing I'll point out, and I don't want to deviate too much here, but that same pattern that you just referenced, that's also a classic bull flag there, where you've got that downtrending channel formation, and then you have the clearly defined breakout with the green candlestick out of that channel. So there's your bull flag formation. Once you break out of that channel, it at least portends a move that captures the high and low of that channell. So
Yep,
that's kind of the objective of that channel. When you break
for
out of
sure.
that channel, that's the objective there.
And we could go all day long
Yeah,
talking
yeah,
about technical analysis, but I will make one last comment on this. The thing that I think I read somewhere, there's no one technical analysis that is going to be the trigger or that you can hang your hat on. But if you are looking and you see several different indicators pointing to the uh, same movement or same pattern, then you can start hanging your hat on it. So
yeah, absolutely.
you look at the patterns in the chart, you look at the patterns in the open interest, you look at the patterns in the volume being traded, and that's why we keep talking about the things we talk about. What's going on with volume? What's going on with open interest? Do they confirm the trend that we see in the market? And absolutely. So one quick thing I'm looking at here is our gain in open interest has started to flatten out a little bit. And guess where it
Yeah.
started to flatten out? Right when the market started to go sideways. So I guess if I looked at this and I saw this open interest start to maybe roll over, it probably could tell you that that would be an indicator that the trend could be over.
Yeah, and I think the other big part of that kind of sideways open interest structure is that you have to remember that commodity funds are huge participants of momentum. So as long as the momentum is trending in one direction, then typically you'll increase open interest from a commodity fund standpoint. The second you stop making higher highs or lower lows, then you typically will slow down commodity fund participation, where with the new highs today in futures, it'll be interesting to see, do we get a big bump up in open interest? You get a resumption of that build of open interest with, if the momentum is going to continue to push to higher highs, do you get that resumption of commodity fund interaction? And that's kind of, the big thing when funds are drivers of markets. Fundamentally, can you justify what they're doing? Because if you can't fundamentally justify commodity funds entering a market, typically when they stop, you'll get this void underneath the market or above the market, depending on the direction they're entering in, to where the underlying fundamentals better be there to back up the commodity funds and what they're doing and chasing that momentum. And this is all stuff that we can kind of go over and visualize with some of the other stuff we're going to go through here.
Yep, and we got a comment here. This is Skylar Reese said the market doesn't like sideways. Well, there is a segment of the market that does like sideways, and it plays right into the options conversation that we have. Um, okay, we are going to jump into your presentation now. Why don't you share your screen?
Okay. Let's see here. should be good. Do you see that?
Um,
Let me pull
not
this
yet.
up here. Hang on 1 second here. Okay, here we go.
Oh,
Ooh, hey now. What's going
that's
on there?
trippy.
Yeah. Let me try that again.
You're sharing the wrong screen.
Yeah, I don't know what's going on there. Let me stop and then try that again. Hang on
Kind
one
of hard to
second.
believe we could find a screen that's uglier than the two of us.
Yeah.
Actually, uglier than that sweater you have on.
That this is my ugly Christmas sweater.
Woo! Um,
Let's see here. Let me do it this way. Let's see.
Ashley says 2x6. Oh, 2x6, 104 and 5/8 studs.
Oh, you know,
And number
yeah.
2 for prompt sale in Dallas and prompt for sale prompt in Dallas. I will say, we're seeing the basis trade come to fruition. Guys I know who have wood that's hedged up are offering it out, which means they're not underwater on their basis anymore.
All right, like let me try to share this now and see if it likes this. Let's see here.
There we go. That looks better, I think. All
There we
right.
go. Okay.
Took us only 10 minutes in to get
Yeah.
to the lumber futures week in review. All right, we
So
go.
I'll
Yeah.
run through this quickly. This is just you had this pulled up with bar chart, but this is the Jan daily. So you can see December 14th. This was last week when you flew solo, back to December 28th. So you had a nice correction. You kind of held a series of different moving averages here. Again, this is just a nice corrective move in an uptrending market. And then today we've made all-time highs. The next objective now is going to be somewhere into this Bollinger Band, this 1183 to 1200 area. So the one thing I want to point out is, when you look at this corrective move in futures, nothing really changed fundamentally. You still had an uptrending physical cash market. So you look at these next two charts. Well, here's the mini S&P, and then here's February crude oil. So I'll go back. Mini S&P, we had another series of bad news with the new variant with coronavirus. The equity markets had a big corrective move. I think at one point the Dow was down like 1,200 points collectively. So from a timing standpoint, you can see here, this meshes up with the sell-off in lumber. Here's the sell-off in lumber. Here's the sell-off in equities. So you had outside influences, extraneous influences impacting lumber. Even though nothing fundamentally changed, cash was still uptrending. People scratching their heads, what's this corrective move in lumber futures? Well, a lot of it probably had to do with the fact that both the equity markets and the other physical commodity markets, here's crude oil, had bigger corrective moves. Once you got stability in crude oil, once you got stability in equity, go back to this January chart and see that they kind of mimicked what the equity markets are doing, what the other physical commodity markets are doing. So I think you might not watch these other markets on a regular basis like you would watch lumber, but globally you have to at least be cognizant of the fact that the outside markets, especially equities, the energy markets, can influence lumber in that, if the other physical commodities are having a big sell-off, if the energy markets, the ags, the softs, well, the spillover effect can be that commodity funds obviously trade these other markets. So if they're no longer buying crude oil, if they're in liquidation mode with some of these other physical markets, the same thing can happen in lumber here as far as how they stop buying or they start to just liquidate lumber positions
Yep,
in
that's
tandem with what they're doing everywhere else.
the chart never lies. It tells you the truth every
Yeah,
time.
yeah. So then
So
we'll
here
do
we got a quick question. Are customers still ex-pitting and standing for delivery at times, selling their futures contracts to a mill?
I'm sure that there's going to be the usual suspects, but unless you can't physically find the wood, I'm not sure conservatively, let's say cash is a 1025 to 1050. Maybe it's a 1075 market. I'm not sure why somebody's going to stand in being long January with January today. I can sell January at 1140. Unless you can't physically buy the cash, my suggestion would be you just sell your January and go buy the cash. You might as well crystallize the premium in January futures. Take advantage of the premium in the board relative to just sitting in there taking the wood. The people that will take the wood are obligated or locked in where they're going to do X amount of contracts on a contractual basis with the sawmill.
And you know what? We're going to talk about this in a little bit, but here's the open interest this morning in January, 740 and dropping. So
Yeah. And so that
you know,
equates to about somewhere around 58 per day, which historically is pretty normal given the size total open interest. It's a normal amount to liquidate. I think we have, let's see here, as of this morning, we have, look at my calendar here. As of this morning, including today, we had 14 days to liquidate here before January expiration.
Yep, and we know the 740. I mean, it's 740 cars. It's not that significant of a number, and
No.
we know that it's not going to get delivered. All of these are not going to get delivered. All right, back to yeah. There you go.
So
Heighten
we'll
that.
run through the bases here quickly. 2 weeks ago, the last time we were together, we had that historical basis where cash was trading $214 under January futures. Fast forward to last week, you had complete convergence between cash and futures, where a week ago futures were 1,017 in January, cash was 1025. So you had convergence, and then you flip to this week, and you're back to this kind of with the parabolic move in futures here. You've kind of gone back to cash, and again, you're going to get arguments that I showed cash at 1025. Frazier was still 1010 on trucks. Print was a 1015. Where is cash? You're going to get arguments on where cash is. I think Random reference today, they've heard numbers between 1050 and 1150. If I'm a betting man, I think print's going to be somewhere around 1050 to 1075 tonight. We're only going to get one weekly print tonight. January obviously is in this 1130, 1140 area. So you're back to a pretty significant basis going into the end of the year, which, again, doesn't make a lot of sense why January and March need to be this far ahead of physical cash, unless physical cash print is just woefully behind and cash truly is, an 1100 type market. But you're not getting a lot of strong answers out there. And again, you see it on your platform, where is cash? And I think cash is all, again, it's very geographical. Is it a truck market, a car type market? Are you buying Eastern versus Western? And you'll get a lot of divergent answers here as far as where cash is.
Greg, I want to point something out here. This is really important. Let's scroll back 2 slides. Okay, negative 214 on the 14th of December. Next slide. +8. That works out to $25,000 of basis gain in a week. Okay, 2 important things to know here. Number 1, if you are a basis trader, you make hay when the sun shines. So that means the basis came in. Those basis traders were going to exit their cash position, exit their futures position. Why is this important to someone who's not a basis trader? If you're a lumber buyer, don't go to the mill when the basis comes in, because the mill's not going to sell you cheap. You go to the basis traders, anyone you know who has wood in inventory. We sold a whole lot of wood on Materials Exchange for a particular user who is a good friend and a basis trader last week. Guess what? The basis came in, he exited his position, and he sold at what you would think are too cheap levels underneath the mills. Why would he do that? You do it because the basis comes in. So from a strategic standpoint, it's very important to pay attention to where the basis is at and factor that into who you're buying from. and who you're going to actually talk to.
I think that's
And
a great point, Mike. I think that's, if you're a basis trader, again, your concern is the convergence. The speculation is cash has to go higher, the board has to go lower. But again, I'm just going to jump back and show this January chart. I mean, again, this corrective move, when you go from 1136 basically down to the 999, I think we traded down into the 990, 989 area. That's a real move. You can crystallize when you're short January or even short March. This is a real move where cash is still uptrending. The futures has this corrective sell-off. You can crystallize the basis, and absolutely, people absolutely did crystallize that basis opportunity.
and now roll back to the third basis chart, gone. Now you're at negative 100 again. So all of a sudden, you're talking to your guy who you buy from, who's a basis trader, and he says, "You were so inexpensive last week. Now this week you're not. What's going on with you?" Well, you should know. The basis is working against that position.
Yeah, no, I think that's a great point, and so the only point here is that so January is physical cash. At some point, either cash is going to move dramatically higher over the next week to 2 weeks, or futures is going to have to settle down, or somewhere in between lies the truth. But you're not going to maintain $100 basis here in the next 2 weeks. You're going to converge one way or the other.
And as the volume of open interest, as the open interest in that front month goes lower and lower, the volatility picks up. The timing of your exits needs to be so much more precise. So this thing did exactly what it was supposed to do. Within 4 weeks of expiration, it converged.
Yeah, absolutely. And my only point with January being a declining contract, anybody that's still in January, the answer is, why are you still in January? You better know what you're doing, especially as you start to liquidate from 740, sub 500 to 300 contracts, where you better have a vested interest, or you better have a pretty good rationale why you're still long January at conservatively $100 premium to physical cash. When you have the opportunity to roll into March and be realistically in a more liquid contract. So here's the March contract. You had a very similar move. The big sell-off, the big rebound took out the highs. The objective in March now would be the Bollinger Band area of 1160. Basis-wise, this is 2 weeks ago. March is trading at $169 premium to cash. A week ago, you had absolute convergence where you could have come out of those March basis trades. And I understand it's easier said than done, that you can't necessarily liquidate the cash, this far out when you're in March, but you did have convergence. And then flip to this week, March is in this, this is probably in that same $100, $105 area right now.
Yep, for sure. All right.
And then the other one I just want to point out here for producers, here's May. And May, historically, you should be somewhere. A year ago, May was trading basically $60 under physical cash, and that's being conservative. So from a producer standpoint, you have the ability to sell May right now. May's lock limit at 1059.70. Okay, let's say that cash is 1050 even, or 1075. You have the opportunity to sell May production at a slight premium or equal to where you're selling physical cash today. This structure is a no-brainer for producers. Sell the futures, build out your physical, your order file here in physical cash. This is an extension using a massive premium in futures. A year ago, you had a massive discount structure in futures. At least now you're getting compensated by selling a premium in futures in the back months relative to where you're selling physical cash today.
Yeah, we actually had a conversation last week with someone who's building a new Southern Yellow Pine mill. And, they're sitting there looking, how am I going to recoup my investment? And the comment from the gentleman was, I would sell all of my production for the next 2 years at these levels.
Yeah, absolutely. And so here's, I will run through this quickly, Mike. Here's the Jan-March spread. I know 2 weeks ago we talked about, how January trading at this massive bloated premium to March was unrealistic given the massive historical basis in place. And lo and behold, in the last 2 weeks, you've seen an absolute collapse of January, March. So January has collapsed in, March has gained relative to January. So, yesterday we traded down. We basically went from 2 weeks ago in this 55 to 60 over area. We've traded into even money to 5 under. So you've had this collapse where March has held its value relative to January. And so this is why it's important to understand the spread structure. Why am I owning January at this massive, historical basis to cash? Why am I owning January at this massive premium to March? There better be some pretty good, rationale reasoning behind it, because in not understanding owning January or March, if you own January relative to March, you left $50, $1,000 on the table here.
Well, and the question is, why are you owning it? Because you are probably not in the lumber business and you want to get long lumber. There's one way to get long lumber and be able to exit that position in a short, very easy way. It's called buy futures. So it could be the funds got in and did really well.
Yeah, no, and I think part of this too is the fund long roll started a little bit earlier, ahead of the holidays. So the funds have significantly influenced this move from about 30 over into the lows here, where you've had big fund rolling day after day after day, just out of the January longs into March. So they've been pressuring the spread end as a result. Here's a continuation chart. We won't spend much time. Again, the objective, that 62% area, is still the 1223 area. So, again, we talked about those Bollinger Band highs, 60, Fibonacci numbers. So your objective is this 1160, 1180 area in March and Jan, to the Fibonacci up at 1223. Here's open interest. Again, this is 2 weeks ago. You can see total open interest was 2224. A week ago, 2363. You can see how January 1240. A week ago, it liquidated down to 1061. As of this morning, we were 1273. January is down to 740. March is up to 1392. So you really are still gaining open interest, but not as dramatic as you were, where, again, it'll be interesting to see with this resumption of new highs, this resumption of the uptrend now, does that engage more commodity fund type longs to chase the momentum higher here? And if the answer is yeah, then you should see a bigger build in total open interest, but you're going to see it in March and May. January is still going to be that declining contract. The new longs are going to materialize in March and May here, along with new shorts.
And there's also plan your trade your plan. The one thing about funds is they need a reason to exit. They don't just say, oh, it seems like the top right here when the market's screaming higher. You'll need the market to actually roll over and hit a trigger that will cause them to exit.
So I think absolutely, Mike. And the one thing people have to be mindful of is that commodity funds rarely exit on strength. They're greedy in the sense that they want to capture the most momentum possible. Typically, especially historically in a market like lumber, commodity funds do a magnificent job of entering a market. They do a disastrous job of exiting a market. Typically, when a market rolls over, they're the last in, and then ultimately they're the first out when the momentum stalls. So this is something to be mindful of. 2 weeks ago, you had this build, and here's the managed money. These are the commodity fund longs. So 504 up 177. Fast forward to last week, you had a light liquidation, and that probably is, you had some of the weak-handed fund longs liquidate on that move lower in January. Instead of rolling, they just liquidated their Jans. And then you flip forward to last week, you had a resumption of the commodity fund longs. You really didn't see any significant changes with producer shorts. But again, my point here is, jump back. My point here is that when the momentum ultimately rolls over, this is the number to watch, because this will come back in line with the short position, where you look at the starting point. The starting point was close to 0 or close to 50 to 100. It's increased substantially. It's up to 584. When this market rolls over, this will create, just like you have all these limit moves to the upside now with the commodity funds chasing this market higher, you'll get the inverse. When these guys liquidate, they want out. They're going to punch the sell button, and that's going to cause just as much volatility inevitably, especially if the underlying fundamentals don't support this move higher. When these guys liquidate, they're going to cause the volatility to the downside.
Absolutely. Absolutely. Um, all right. So we're at the 30-minute mark. Let's touch on some options real quick here, and we'll wrap this up.
Yeah, and if you want to, I'd love to go over your example again, Mike, just to see. I know you did an example last week, and I think it's a relevant example week over week here.
Oh, are you expecting me to pull that back up?
Do you have it?
I do somewhere.
If not, we can just we can come back to it next week, and I actually have a quick example we can go over just
Yeah,
to
let's
take
do that.
advantage of. Okay. Uh, so I'm just going to jump forward here. Sorry. So here, okay. So buying an option, you pay something. Selling an option, you receive premium. So I buy something, it costs me money. When I sell something, I receive money. So one of the examples I wanted to show, and this is something I'm doing with producers, inventory hedgers, basically the last couple of days with the resumption back to new highs in March. So March options, you have 62 days to expiration. So they go off the end of February. So I still have lots of time here. And one of the examples I'm looking at here, this is called a risk reversal or a credit spread. I'm going to buy a March 950 put. I'm going to sell a March 1250 call. And why am I picking these strike prices? Well, March last week traded down to $970. If you can believe it, a week ago, March was at $970. And that 1250 area, that's kind of slightly above the 62% retracement area we just talked about. So the example here would be to buy a March, and these are actual trades. This isn't theoretical. I'm doing this today. I'm buying a March 950 put at $43. I'm churning around. This is done on the same trade. I'm not legging into these. I'm doing these as option spreads. I'm selling a March 1250 call at 70.10. So I'm paying $43. I'm collecting $70. The net impact is it's a credit spread, meaning I'm collecting $26.90. So my net short position is that 1250, which is the call strike price that I'm short, plus the 2690 I'm getting credited for. So my risk is anything dollar for dollar above 1276.90 through the end of February. Okay, so if I'm a producer, if I'm wrong, I'm going to be selling March futures at 1276.90. So my risk is anything greater than this number here. And my reward is going to be the 950, the put, plus the 2690 I collected. So my reward is going to be dollar for dollar, anything under 976.90 before the end of February. And again, the relevance of these numbers, this is $50 above 62% retracement. This, is it unrealistic to go back to 976? The answer is no. You were just there last week. So these are relevant, in my mind, these are relevant strike prices from a put and call standpoint. And I've got plenty of time. I've got until the end of February for this to play out.
Well, and you don't need it. You're locked in. You've put your hedge on.
Yeah, exactly.
It's a great way to hedge without using a futures contract. It reduces your margin requirement. All in, it's a good thing.
Yeah, absolutely, absolutely. So I think we'll week to week we'll kind of revisit this trade. We'll look at different option trades, and we'll continue the option education. We'll continue the option education just week to week here as well. And if people have questions, then by all means, please email Mike or myself or Ashley, and any relevant questions or commentary, how we can improve this, or we're what we're not covering, we're all ears. We want to make this as user friendly as possible here.
Absolutely. So, hey, great show today. I think we covered some really important things. Most important in my mind is get comfortable looking at a chart, and make sure the chart is telling you what you need to hear, and then know when that basis comes in. And that basis coming in is nothing but opportunity for both sides of the trade. It's bizarre to say it, but it is a win-win. And of course, when you say, "Oh, nothing's a win-win," who's losing on that? Well, the people that are losing on it are whoever gave that risk, that hedge, whoever took on the hedge risk from the basis trader. So it's a third party outside of the interaction you're going to have with the basis trader, if you're the buyer. I hope I said that.
Yeah, absolutely, absolutely.
But yeah, look, those are excellent opportunities for you as a buyer to buy under the market or better than the market, and it's a great opportunity as someone involved in the lumber industry to put on a basis trade and pick up some good money. So with that, let's wrap it up. We got some new messages. Oh, of course, you guys all know that was Greg Kuda. That's me. And contact us if you have any more questions. If not, we'll see you next Tuesday.
Tuesday. Definitely. See you next Tuesday.
All right. Merry Christmas. Happy New Year.
Yeah. Happy holidays, everybody. Merry Christmas and Happy New Year. Thanks, Mike. Take care.